Friends, welcome back to our channel OMSAI Bhojanapalli.
Good morning, friends. So we are doing that chapter, portfolio theories. Stop talking. First word I speak always is stop talking. What is it? Yeah. Allow me to say something different in the subject, please. Now, don't talk, please. Now, we are discussing the area portfolio theories. In which, in yesterday's class, we completed Markowitz, also saw Tobin's capital allocation line, CAL we discussed. Today, we will see how the capital allocation line can get converted into CML, capital market line. Please. This capital market line brings into picture something called as market portfolio. The concept called as stock index will come into picture in this area called as capital market line. From there, it will be further developed into the model called as capital asset pricing model, CAPM. So today we will try to complete up to the introduction to the CAPM. If possible, try to do one or two problems also in the CAPM. As I said, at the end of today's class, lot of discussion which has been made will be concluded. With this background, so many problems can be done in the next class, okay, later classes. Again, such a huge discussion will come into picture only when I go to sharp single index model later. Till then, all CAPM problems can be quite easily done and understood with the help of these background discussions. Okay, now, don't get worried. After today, I will not be speaking too much about the chapter. We will start doing the problems too many. Okay, please. Stop talking, please. And I also believe that with so much discussion only, number clarity can be obtained while doing the problems. This is a real way in which the chapter should be learnt also. Okay, now let us summarize. Then we can just move on to the capital market line and then finally to the CAPM, capital asset pricing model. Please. We saw that to value an asset, we should know the discount rate. Discount rate depends on the risk of the asset. Two things one should understand for valuation. Number one is how to measure a risk of an asset. Number two, how much return one should ask for a given level of risk. These two questions are only sought to be answered by this chapter, portfolio management. So it is all about discovery of discount rate. We can call as this chapter's main objective. We divided that chapter into 6 segments: risk return profile, Markowitz portfolio theory, capital asset pricing model, sharp single index model, arbitrage pricing theory, and finally efficient market hypothesis, in which we completed the risk return profile and also Markowitz theory. We are in the middle of the road from Markowitz to CAPM. In the journey, we have completed capital allocation line. Another discussion, if we complete, we will move into the CAPM. Risk return profile, what is discussed? Number one, we saw that return of a security is its holding period return. Normally we calculate return per annum. You may ask why we calculate annual return. The reason is all percentages quoted throughout the world are annualized percentage. Okay, when even calculate return per month, if you decide to have a 1 month holding period, but we always express any return in what? Annualized, because the interest rate quoted by a government of India bond is also what? Annualized interest rate. A bank interest rate quote is also what? Annualized. Accounting profit report is also annualized and so on. So everywhere in the world they use 1 year as a benchmark. So we say return means an annual return from the stock. Everybody follow not? How to calculate the annual return? Very simple. Year-end price minus year beginning price plus dividend whole divided by K, that is P0. K in a capitalization whole divided by P0 gives you the whole divided by the year beginning price, gives you the return of a particular security. Now, when I want to understand a security, I should know two things about it. What return I can expect from that security. Number two, how certain is that particular return. These are the two features of any financial investment. The return which I expect will not be extreme. I always expect only average return. So the word expected return should be understood as average. And the risk is going to be the deviation around the average return or the variation of the return. So the return average can be simple average or weighted average based on whether I do a past trend analysis or a scenario based analysis assigning the probabilities. And the risk is also standard deviation without probability sigma x minus x bar the whole square divided by n square root with probability sigma p into x minus x bar the whole square. Once you know how to understand the return and risk of an individual security, one should know the risk and return of a portfolio of securities. A portfolio can have a return, a portfolio can have a risk. What is the return of a portfolio? Weighted average return of the individual securities. Risk of a portfolio is not equal to weighted averages. Sigma P is equal to W1 square sigma x square plus W2 square sigma y square plus 2 into W1 into W2 into sigma x into sigma y into correlation of x and y square root gives you the sigma P, the standard deviation of a portfolio. Right or not? Now, that means portfolio standard deviation risk depends on three aspects. Risk of the individual security, proportion of investing and the co-movements. If I have a portfolio consists of many risky securities, portfolio become risky. Portfolio consisting of riskless security, portfolio become riskless. Proportion also important. More of a risky, less of a less risky in a portfolio risk increases and vice versa. Not only these two, even with the risky security portfolios, my risk can be what? Reduced through the negative correlation. Everybody right or not? In the case, co-movement is measured through the correlation coefficient. What is correlation? Covariance of x and y divided by sigma x into sigma y. What is covariance of x and y? Sigma x minus x bar into y minus y bar divided by n or sigma p into x minus x bar into y minus y bar. This correlation can take values between -1 and +1. -1 perfect negative, -1 to 0 negative, 0 no correlation, +1 0 to 1 positive, +1 perfect positive. As long as the correlation is not +1, I can reduce my risk through diversification. +1 no risk reduction through diversification. When correlation is -1, sigma p is equal to W1 sigma x minus W2 sigma y. When correlation is +1, sigma p is equal to W1 sigma x plus W2 sigma y. Right or not? When correlation is -1, we saw that risk of a portfolio can be reduced to 0. Proportion of x is equal to sigma y by sigma x plus sigma y. Proportion of y is equal to sigma x by sigma x plus sigma y. Then we saw that when you have a 3 security portfolio, the sigma p will be W1 square sigma x square plus W2 square sigma y square plus W3 square sigma z square plus 2 W1 W2 sigma x sigma y correlation of x and y plus 2 W1 W3 sigma x sigma z correlation of x and z plus 2 W2 W3 sigma y sigma z correlation of y and z. Take what? Square root gives you the standard deviation of the portfolio. We saw for a n security portfolio, will be having how many terms? N square term, n variance, n into n minus 1 covariance terms. As the number of securities increase in the portfolio, the individual risk variance becomes irrelevant. What becomes relevant is only the co-movements or covariance. Because if we have a say 100 security portfolio, we'll be having 10,000 terms. Yes or no? In the only 100 will be the variance terms. 9,900 will be what? The covariance terms only. Respond yes or no. Then with this we completed the first start, namely what? Risk return profile. Then we moved into the Markowitz. In Markowitz, we started discussing by assuming a 2 security portfolio. Share market has got how many securities? 2 securities, A and B. A is low risk, low return. B is high risk, high return. In a low risk, low return portfolio, when I injected B, a high risk, high return security, what happened? Return increase, but at the same time, the risk decreases. The reason is due to the correlation coefficient or the benefit of diversification. So when I injected more B, return increase more, risk decrease. Still return increase, risk decrease, and so on. The curve began to move leftwards because of risk decrease of diversification and upwards due to the return increase. After some time the curve begins to move rightwards. This leftmost point we call as what? Minimum variance portfolio. This is found out using the formula proportion of A is equal to sigma B square minus sigma A sigma B correlation of A and B divided by sigma A square plus sigma B square minus 2 sigma A sigma B correlation of A and B is what we call as minimum variance portfolio. When correlation is number other than minus 1. When correlation is minus 1, the risk can even be reduced to what? 0. Above the only now we saw the proportion. Proportion of A is equal to sigma B by sigma A plus sigma B and vice versa. Right or not? When correlation is plus 1, then always the line moves only towards right. The minimum variance portfolio is investment in the lowest risk security. Everybody, right or not? No. Question is, why should we know minimum variance portfolio? From that portfolio, if I continue the curve becomes what? Efficient frontier. Tell me, what is an efficiency frontier? It consists of those securities and portfolios which are efficient. What is an efficient security portfolio? That exists no other security portfolio that give a higher return for a lower risk, higher return for the same risk, or same return for a lower risk. Markov is concluded by saying that you should make the investment only in the securities lying on the efficiency frontier. Any security below that is inefficient. There will not be any security above what? Efficiency frontier is what Markowitz concluded. Response is or no? Clarity now. Now Markowitz shifted his attention from the market to the investor. All the securities are efficient, I don't deny that. But will I invest in 3, a low risk, low return, or what? In 6, high risk, high return? Question arises, no. It all depends on the investor preferences. So we classify the investors into 3 types: risk lovers, risk neutral, and risk averse investor. Risk lover investor is willing to pay money for taking the risk for the excitement is generating for him. Yes or no? Risk neutral doesn't consider risk at all. He only looks at the return. He tries to maximize return at any risk. Are you following what I am saying? And the third is what? Risk averse. He doesn't like to take risk. If he has to take risk, he will ask a premium from you. So Markowitz concluded that throughout the world, 99% of the investors are what? Risk averse. Based on that only all modern portfolio theories are developed. Everybody following not? So we don't have a theory for risk lovers. Yeah, theory only for what? Risk averse person. Response is or no? Now, how much you are averse to risk is called as aversion factor A. We call as what? Aversion factor, risk aversion coefficient A. There are 2 types of investor, namely what? Conservative and then what? Aggressive investor. Conservative investor wants more return for taking a risk, and the aggressive wants what? Less return for taking a risk. Yeah, otherwise, he asks for a higher risk premium to take that risk. He asks for what? Lower risk premium to take that particular risk. Response is or no? So, to get the same level of happiness from a risk taking, he wants more premium, he wants what? Less premium. Why he wants more premium? Because his A, the risk aversion factor is what? Higher, and his A is lower. You have an utility function, U is equal to, what's the formula? Expected return plus half into A into the variance or standard deviation squared is going to be the formula. Response is or no? So utility is called as happiness. What is utility? Happiness. My happiness depends on following. If I see a security having a high return, I am happy. Yes or no? Low return, I am unhappy. So happiness depends on the expected return of a security. Yes or no? Now the security with a higher risk, I am what? Unhappy. Lower risk, happy. So the risk is going to what? Be having a adverse effect on my happiness. How much unhappy I am about taking a risk is magnified through the adjustment factor. This is what we call as a utility curve. Response is or no? An investor can have more than one utility curve. The topmost curve gives him the highest happiness, and the bottommost gives him the lowest happiness. Any point on the curve gives him the same level of happiness. He puts the curve into the market and sees the efficiency frontier. Wherever the curve meets what? The efficiency frontier for the first time, there will be a security is going to invest. Yes or no? That point of intersection we call as a tangency point. We call as efficient portfolio. Is this efficient portfolio for everybody in the market? No. Because it is your utility curve. This is your efficiency portfolio. My curve differs. It may be different. Everybody, yes or no? It is a function of utility curve and then what? Efficiency frontier. Now, in that case, here Markowitz stopped and said, I should invest my money in this particular portfolio or security. Is what Markowitz concluded. Response is or no? It was continued by Tobin. He said, don't look at only the risky assets market, the share market. There's another market having what? Risk-free asset. It may be a debt market or bond market. Right or not? So let us try to combine risk-free asset with what? Risky asset. So what he says is, we have a risk-free asset. Combine RF with this first portfolio, RF with second portfolio, like that. RF can be combined with any security inside what? Efficiency frontier. Yes or no? In that case, what happens is, we'll be having multiple lines. RF with security 1, RF with security 2, RF with security 3 and so on. Everybody find out. There will be multiple line and there should be one line. That is called as what? Line of tangency. Where the line is going to run tangent toward the efficiency frontier, the point of tangency called as what? Efficient portfolio. Now tell me, my efficiency frontier is Markowitz frontier or this line, this line. This line, now we give a temporary name called as what? Capital allocation line. Later I am going to make this as what? Capital market line. Can I or not? Now, what is this capital allocation line? If I have 100 rupees, I'll either put the 100 rupees in what? Risk-free asset, or I put 100 rupees in what? Market asset. What asset? That asset forming in the point of tangency. I will not invest in this security, I will not invest in this security and this security. I will be investing only in what? The point of tangency. 100 rupees either put in risk-free asset or put in what? Yes, the market security, or put in the portfolio of what? Both. If I put the entire 100 rupees in risk-free security, the return is risk-free return. Yes or no? If I put the full money in what? Risky security, the return is what? The security return. If I put in combination, the return increases, the risk also increases. If I want to invest more than 100, I'll borrow invest, the capital line gets extended. Right or not? So in this case, the return of portfolio is weight of risk-free asset into risk-free asset return plus what? Weight of security into return of the security gives you the portfolio return. The risk of the portfolio is what? Sigma P is equal to WS sigma S. That has been proved through this particular calculation. Everybody following or not? And for that we did some problems also in the workbook. Question number 10 and question number 11, it speaks about the capital allocation line and also how it is superior to the Markowitz. Now one thing is conclusive, my efficiency frontier is not Markowitz, it becomes what? The capital allocation line. Up to this, everybody following or not? Iduvarai, like a mega serial, till now, I only summarize here. You can understand that how much we have covered. So long we have discussed the summary. This is the in essence what has been discussed till now. Now we are going to proceed further. Idike 20 minutes gone. Right or not? Now, I purposefully summarize because link will not be obtained if I just straight away go into the next stage. Hence the summary has been done. Can I proceed or not? Next. See, let us make some conclusion about the Markowitz and capital allocation line, which will lead us to the next area called as capital market line. See, this is the efficiency frontier. Right or not? Okay. My question is, everybody in the share market, all investors should form the same efficiency frontier, or they can have different. I am speaking only about Markowitz. I am not speaking about any other. Say I don't bring the capital market line. Okay, tell me, as per Markowitz, you and me, both of us should have the same efficiency frontier, or both of us can have a different efficiency frontier? We will have different efficiency frontier. Reason is very simple. See, all these points are expected return and risk. These points, these are two security portfolio in this example. Now, these points came because security A, if you look at the workbook question number 8, is expected to give how much return? So, security expected to give how much return? Question number 8. Workbook security how much return? 12%. What the risk here? 20%. Security be expected return? 20%. Risk is what? 40%. Please. This is a efficiency frontier if security A and security B is having 12%, 20% return, 20%, 40% risk, and a correlation of 0.2. All this should happen for this to be an efficiency frontier, right or not? You may have a different expectation, I may have a different expectation about the security, right or not? When you calculate the expected return, suppose you go by scenario analysis, I go by past tense, possible? Both of us do scenario analysis. Yeah, you are saying 10% probability for situation 1, I may assign 20% probability, right or not? For a situation 1, you may expect 20% return, I may expect 18% return. Everybody follow what I am saying? Because all these are not written agreement, all these are projections. The word written is what? Expected return. So you may have a different view about the company, I may have what? Different view about the combination, etc. So for everybody, the risk return need not be same. The risk return need not be what? Same. You may have a different return expectation, different risk of that. I may have what? Different numbers. In that case, you may have a different efficiency frontier. I may have what? Different efficiency frontier. Respond yes or no. In the issue, should I repeat? Those who want to repeat, raise your hand. Okay, very simple. Again I say, shh. Stop talking. Again, listen with intent. I am saying I can repeat n number of times. Listen with what? Intent. You should understand everything before I proceed further. Okay, now I am asking a question. There is a efficiency frontier. Forget about N securities. There is a stock exchange consisting of 2 securities. In India, only 2 companies are there, A and what? B. 2 securities stock exchange is there. In the stock exchange, I also want to invest, you also want to invest. Now, 2 securities are A and B. No. They form for different combination. This as the efficiency frontier. Enna right or not? The question I ask is this efficiency frontier, it should be same for you and me, or can it differ? This is the question. Each investor can have his own efficiency frontier is the answer for that. The question is why? The question asked no. Very simple. I may expect from a 20% return for a risk of 10% above. I may expect 12% return for risk of 20%. That is my expectation. For the same security A, you may calculate expected return as 10% for risk of 18%. It is possible or not? Because all of us are only shooting in the dark. What I am saying? Because you may do scenario analysis, I may do what? Past trend. Every investor has got a different expectation about the same security, return and risk. Yes or no? Then you will construct your efficiency frontier based on your expected return and risk. I will construct mine using what? My expected return and risk. That means you may have a different efficiency frontier. I may have what? Different efficiency frontier. You may have a different utility curve. I may have what? Different utility curve. That means Markov says each of you do the homework on your own and select the security. Right or not? In the issue, so nobody can say common, okay? Nobody can say what common. This is the best security. So this is the efficiency frontier. What may be inefficient security for you may become what? Efficient for me. In the case, Markowitz gave a guideline how to invest, but the investment should be calculated and done only by what? Investor. It is a very difficult process for every investor. 2 securities, even I can do, you can do, whatever. But if you look at the stock market, minimum in a stock exchange, there are 1,000 securities listed. In any stock exchange, 1,000 securities are listed. At least there are top 50 companies to 500 companies in big stock exchanges. Are you following or not? In that case, let us take for example 50 security company, 50 security stock exchange. You may having 2,500 terms for a single portfolio. N squared, yeah, correct? 2,500 terms. Otherwise, we have only N variance term, that is 50 terms, and then 2,450 becomes what? Covariance. For every security within each other, I have to find out correlation. Right? What I am saying? Becomes what? It is very cumbersome. Even if you have a system and a team of experts, it occupies what? Huge memory space. It is a very good theory, but the theory was not implemented for a long time because they don't know how to implement it. It was because very difficult. He gave a good, that is, Markowitz should never be undermined because he only gave a modern portfolio investment base. Are you following what I'm saying? But what he said couldn't be implemented in such a huge stock exchange because it's difficult to construct portfolios, find out efficiency frontier. At least one time I do the hard work. It stands now, nobody say because for you it is different, for me it is different. Yes or no? Each one of us should be doing, yeah, right or not? And based on Markowitz only, capital allocation line came, yes or no? And on this efficiency frontier only, I should be comparing you what? My risk-free asset and this portfolio, and then I had what? The capital allocation line. So to draw this line also, I should do the Markowitz first. Everybody, are you following what I am saying? In that case, till this, what I have discussed, are all good background concepts, but these concepts couldn't be applied in what? Stock investments by equity research firms or anybody. So they found it very difficult to implement the Markowitz portfolio theory in the real market. Everybody following not? Not because of the deficiency of the theory, because of what? The impracticality. Are you following not? No. 1950s this theory came here. Till 1960s it was circulated in all paper. People are doing research, but they are not able to what? Implement what is the finding of this into what? Actual practice or actual stock market. Are you following not? Now, then there came a need to make the investment simplified. I should make my investment simplified. If you want to simplify the investment process, you should necessarily make some assumptions. Always, world is complex if you don't have assumptions. If you have assumption, world can become what? Very simple. Because assumption takes out some issues and only small issues needs to be what? Tackled. So what happens is CAPM or CML started making some assumptions. Okay. These assumptions may not be practical. It may be out of the world assumption, but you should not criticize a theory because it has made assumption. We should say that theory, because of the assumption, has made investment what? Simpler. Okay. Then you may ask, sir, due to assumption only investment is made what? Simpler. Is my investment right or wrong? Question arises, no. Whether that investment work or not, they had empirical proof. They had what? Empirical proof. Empirical means what? Real data they collect and check whether CAPM is right, CML is right. It was proved to be correct. Everybody, are you following what I am saying? So in that case, now we are going to simplify the entire discussion. We are going to what? Simplify the entire discussion by making what? Some assumptions. On the basis of the assumption only, the remaining portfolio theories are going to be developed. Everybody following or not? Tell me, why should I make assumption? Because without assumption, I could not do anything. So why should I make assumption? Only with assumption, I can what? I can what? Simplify my process. Rumba simple. Yeah. I'll ask one question. In examination, whatever I discuss will come. We assume that it will come. Hence we are doing it. Yes or no? Something other than I discuss may come. In that case, you will not join class. You will be saying where to go. You know what I am saying? In that case, you assume something and you do everything in the world. Right or not? Like in investment also, we make some assumptions. Assumptions sometimes may be too extreme, okay, but you should not question it because assumption is not important. Its use becomes what? Very important. It was proved to be working well. So till now they have been using it. Everybody following what I am saying? Most of the finance theory is only based on what? Assumption. Whether it's Modigliani, Miller or CAPM, all are based on what? Assumption only. Don't criticize the theory based on assumption. Criticize the conclusion rate after making the assumption, which make the entire investment process simpler, and they will prove through the empirical research that that assumption is not going to affect the real world scenario. Everybody following or not? Now, let me dictate the assumptions and then continue with my discussion. Can I proceed or not? Write down. Next. So, did you understand the background? Now, write down assumptions. Please. Always when I come to the class, I assume that you all will be silent, listening. Now, then only I can take the class. Yeah? Can I say? Right? Assumption. Heading I am giving. Assumptions in CML and CAPM. For both, same assumption. Assumptions in CML. CML na capital market line. Assumptions in CML and CAPM. Assumptions in CML and CAPM. CAPM means capital asset pricing model. Point number 1. All investors are rational. Point number 1. All investors are rational. That is, all investors are rational. That is, they invest purely on the basis of, all investors rational. That is, they invest purely on the basis of mean variance analysis. All investors are rational. That is, they invest purely on the basis of mean variance analysis. This is one of the famous theory question asked number of times in what? Exam. On the basis of mean variance analysis. Point number 2. Point number 2. Investors are risk averse. Investors are risk averse. This already discussed. What is the meaning of this here? They ask premium to take what? Risk. So investors are risk averse. You know, assumption only. They just ignore what? Risk lovers and then what? Risk neutral persons. Okay. Investors are risk averse. Point number 3. Point number 3. All investors have the same set of information. All investors have the same set of information which results in the same expected return. Which results in the same expected return and risk conclusions. Which results in the same expected return and risk conclusions regarding the securities. Which results in same expected return and risk conclusions regarding the securities. And risk conclusions regarding the securities. This is assumption number 3. So this assumption only we earlier said it is no. That is, you may have a different opinion about X, I may have what? Different opinion about X. Now both of us have got what? Same information. So if you expect 20, I will also expect only what? 20. If we have a risk of 10, I will also have a risk of what? 10 only. So the expectations are same for all the investors. Right or not? Next. Point number 3 or 4? 4. Point number 4. Investments are infinitely divisible. Investments are infinitely divisible. Investments are infinitely divisible. That is, there is no standardized market lots. Investments are infinitely divisible. That is, there is no standardized market lots. There is no standardized market lots. Suppose I want to invest 0.0001 share. I have to consider what? 0.0001 share. You can say I have to buy at least 1 share. Not at all. Investment can be what? Infinitely divisible. There is no standardized market loss. Everybody following or not? Next. Point number 4 or 5? 5. Point number 5. No single investor. Point number 5. No single investor can dominate the market. No single investor can dominate the market or influence the market. No single investor can dominate the market or influence the market. No single investor can dominate the market or influence the market. This is point number 5. Point number 6. Point number 6. Investors are in a position to make full diversification. Investors are in a position to make full diversification. Are in a position to make full diversification. That is, there is no barrier. That is, there is no barrier in any investment strategy. That is, there is no barrier in any investment strategy. That is, there is no barrier in any investment strategy. In any investment strategy. Okay. These are all the assumptions we have in what? This CAPM as well as what? CML. Due to this, let us see what is going to happen now. Everybody, can I proceed or not? Now, see. Let us continue with where we left in the previous class now. We left with the capital allocation line. Right or not? Now, see. See. For example, there is a stock market, there is a stock exchange which is having 10 shares trading in it. Okay, that is how many shares listed here? 10 shares. Okay, this is a stock market of the entire world. Assume we're going to stock market of what? Entire world. Having how many shares here? 10 shares. For understanding, I'm saying. Can I proceed? Now, in that case, with the 10 shares trading, all of us will be coming to the same efficiency frontier or not? Tell me. For you and for me, will the efficiency frontier for the stock exchange change? Will be same? Will be same. Why you say it will be same? Because the assumption that you and me will be having what? Same expected return. Both will be having what? Same risk profile also. And both will be having what? Same correlation coefficient. Everything is same. Now, what is efficiency frontier for you will be the efficiency frontier for me also. Respond. Yes or no? Now. This is the efficiency frontier for you as well as what? For me. Now, in that, I will invest in the stock market only in one of the portfolios which is following the efficiency frontier. Now, that too, I will select that portfolio which is running tangent to my capital allocation line. Because I don't have only the stock market of 10 shares to invest, I have a bond market or what? Risk-free market also to invest. So, now I am going to combine a risk-free asset and what? The share market investment. I am going to have a capital allocation line running as follows. Tell me, all of us, the entire countrymen will be investing in this portfolio or this portfolio or the third or the third portfolio. Everybody will put our money in what? Third portfolio, because for all of us that is the efficiency portfolio. Right or not? Right or not? All of us going to be what? Efficiency portfolio, because everybody is having what? Same expectation, same efficiency frontier, same risk-free asset. And one more point I forgot here. Sorry. Write down point number 6 or 7. Okay. You keep in mind, I'll dictate. Okay, point number 7. Investors can borrow and lend. Investors can borrow and lend. Investors can borrow and lend at the same risk-free rate. Investors can borrow and lend at the same risk-free rate. Investors can borrow and lend at the same risk-free rate. That is, if I deposit, I get 10%. If I borrow, I can get the loan at what? Same 10%. Is also an assumption only at the same risk-free rate. Okay. Now, can I proceed up? Now, all of us have identified this portfolio to be the efficiency portfolio. There is no difference of opinion before, say, between us. Everybody saw no. For example, let us take like this. There are 10 securities in the stock market. Yes or no? For example, A, B, C, D, E, F, G, H, I, J. How many securities here? 10 securities. Weak in English, I counted. So, there are how many securities here? 10 securities. Out of 10 securities, this portfolio, for example, let us take for example, consists of 3 securities, A, B, C, in equal proportion. Only an assumption, that is only an example. Yeah? That is, that should be efficient portfolio or not. So, there are 10 securities trading in the stock market. Out of the 10 securities, different combinations are possible. All the combinations, some of them will be falling in what? Efficiency frontier. There will be one combination, will be tangent to what? The capital allocation line. That combination we call as what? Efficient portfolio. Let us assume that that efficient portfolio does not consist of all the 10 shares. Somebody consists only of what? Shares A and B, A, B and C in equal proportion. Yes or no? In this case, let us see what happens to the wealth of the country. What happens to what? Wealth of the country. The entire money would have been invested either in risk-free asset or in security A, B and C, or in the combination of both. Everybody in the country, so let's take one country, so everybody in the country will be would have put the money either in what? The risk-free asset, earning risk-free return, or in what? Security A, B, C, in the proportion 1/3, 1/3 and 1/3, or what? In the portfolio consists of risk-free asset and what? Security A, B and C. In this securities only, all the money would have been put, yes or no? And some would have even borrowed and put what? Money in A, B and C. Any right or not? Because everybody would be willing to be only in this capital allocation line. Nobody will be willing to be there in what? Markowitz efficiency frontier, because the frontier has changed. Right or not? Now, answer my question. Wealth of the entire country is now in how many assets? 4 assets. What are 4 assets? Yeah. Discovery asset, A, B and C. Sometimes even I can borrow and what? Invest. Now, look at this. In this, risk-free asset, if I invest and depositing in a risk-free asset, let's take bank deposit or no. That means somebody should have borrowed from them, right or not? What happened is, there's risk-free deposit and the risk-free borrowing happening after what? CML, both can get cancelled, right or not? Correct? Do you understand? Now, very simple. If I add entire country's investment, add what? Entire country's investment, what is the investment? RF plus ABC investment minus RF. Kadaba. RF is deposit. Somebody would have what? Deposited money. Somebody would have what? Borrowed money. And everybody will put the money in what? ABC. Yes or no? Now, very simple. Yeah. I have 100 rupees. Invest. I deposit 10 rupees in the bank and 90 rupees in what? ABC I invest. Yes or no? Another person invested 110 rupees by borrowing what? 10 rupees, investing what? 100 rupees and so on. Let us add all our wealth. Let's add what? All our wealth in that. The risk-free deposit and risk-free borrowing gets what? Cancelled. Now both are same rate. So what I am saying, what remains is the entire country's wealth will be going into that portfolio ABC. Are you following? Yes, sir. Are you following what I am saying? It goes into what? ABC. Can I proceed? No. In that case, what happens is, there's going to be a huge demand for the share ABC. And all the other shares which are inefficient, not in this main portfolio, for example, D, E, F, G, I, and then what? J, all these securities will not be traded. There will be no demand for those shares. Is that not what I am saying? Now, look at those shares. Those shares are not having any demand because the market feels those shares are highly priced. Those shares are what? Highly priced. Thus giving a lesser expected return. Now, expected return is less because of the high price only. If I invest low price, will say the return will what? Increase. So, market is not buying all the other shares from D to J because the price are what? Overpriced, and everybody is only buying these shares because they are efficient shares. Are you following up? When there is no demand for those shares, what happens to those price? Price reduces. The price what? Reduces. When the price reduces, what happens to return? Return increases. No. Slowly, this is going to happen, and slowly each one of these securities also begin to enter the portfolio. They also begin to starts to become what? Efficient. They also begin to what? Enter the portfolio. After some time, and the market curve vanishes, what happens is, this portfolio will consist of all the 10 shares. In some proportion, some proportion, which they call as market portfolio. It is called as what? Market portfolio, because the portfolio consists of fully diversified shares. Entire market is which we call as market portfolio. Are you following or not? So now, from an efficient portfolio, we come to the conclusion that the efficient portfolio should be what? Market portfolio. If the market is efficient, if the subject to one rider, what is that? Market is efficient, where the overpriced shares will be reducing the price and make it enter. The market should be what? Efficient. But don't ask me is market efficient or not. As a separate discussion, efficient market hypothesis. What I am saying? Market efficient, we can continue further. Inefficient means what? Stop here itself. Are you following what I am saying? This is the main contrast in finance is always market efficient or inefficient. This time 2 Nobel Prize, one proved that what? It is efficient. Another says what? Inefficient. Still inconclusive. Everybody following not. But now, we will now assume that market efficient, inefficient. Now all investors are rational. Market is going to be what? Efficient. Because market efficient, assumption. What assumption here? Investors are rational. Investors are what? Rational. I don't invest on sentiments. I invest on what? Risk return profile. Investors are what? Rational. No single investor can dominate the market. He cannot rig the prices, okay? By a constant buying or selling, he cannot raise the price or sell the price. A single investor will not be able to move the share market. Another assumption. So market is efficient. Are you following what I am saying? Market efficient, market to be efficient, all these things should be happening. That is an assumption in CAPM, CML. Are you following? Now, my question is, what happens here? In this efficient portfolio is now becoming what portfolio? Market portfolio. This consists of what shares? All the 10 shares in some given proportion. Everybody following out. That is, the entire wealth of the country will now be in what? All the shares. This is called as what portfolio? Market portfolio. Respond yes or no. That is why the capital allocation line now become what? Capital market line. It becomes what? Capital market line, where the public will invest either the money in what? Discovery asset, or invest the money in what? The market portfolio, fully diversified market portfolio in the given proportion inside that portfolio. Everybody, are you following what I am saying? So this is going to be the next stage. The question is, so what is so much useful about this discussion? Question arises now? Now, let us now go to the concept of stock index. The index, what index means? Very simple concept, and then come back to this particular theory. I'll be understanding what is market return, what CAPM says. Okay, now we have to discuss about what? Index, and then come back to this particular discussion. Okay, now let me consolidate and then proceed further. Now, tell me, for you and for me, different efficiency frontier, same efficiency frontier. Because every one of us got what? Same return and risk expectation. If all of us have the same efficiency frontier, our capital allocation line should be same or different? Same. The point of tangency should also be what? Same. So every one of us will invest our money either in what? The risk-free asset or the point of tangency. Suppose the tangency portfolio consists of 3 shares A, B, C. The market consists of 10 shares A to J. Assumption yes or no? In that case, all our money will be either in risk-free asset or in the ABC or in the combination or also borrowing. Yes or no? What they say is risk-free asset and risk-free borrowing is going to what? Cancel out against each other. That means the entire wealth of the country will be concentrated on the security called as A, B and C. Now, in that process, all the other securities D, E, F, G, H, I and what? J, all the securities will be having lack of demand. Yes or no? When there is no demand, what happens? The prices fall. When the prices fall, what happens? The return on investment increases. When the expected return increases, they too can become what? Efficient, and they also start entering into the efficient portfolio. Yes or no? Now ABC now become what? A, B, C, D. Then it can become what? A, B, C, D, E, F and so on. After some time, A to J, all of them will go into what? This efficient portfolio. Now I need not call them as efficient portfolio and call them as what? Market portfolio. Ennappa, right or not? This is called as what portfolio? Market portfolio. Now tell me, our will be either in what? Risk-free asset or in market portfolio or in combination, or I can even what? Borrow invest in market portfolio. Right or not? Okay, now see, this market portfolio should have a return risk. It should be having what? Return and risk. Very simple. The risk is here. This is called as what? Risk, which we call as sigma M. We call as what? Sigma M. Sigma M means what? Standard deviation of the market portfolio. Any portfolio can have a risk and return. Same way the market portfolio also should be having what? Risk and return. The risk of the market portfolio should be what? Sigma M. Right or not? And the return of the portfolio is what? It is called as RM. We call as what? RM. The word RM means what? Return on market portfolio. Following not? So the market portfolio should be having a risk. It will be having what? Return. Now, people started wondering how to calculate a return of all the securities in the market and the risk. It becomes very difficult, because we see a market capitalization of a company is maybe 2,000 crores or 3,000 crores. So different companies, daily share market price will be what? Moving up and down. The question is, sir, how to track the movement of what? The market portfolio. It became very difficult. Yes or no? For that, they constructed index. They constructed what? Index. The index movement is the movement of what? The market portfolio. Everybody follow what I am saying? Now let us understand what do you mean by an index, and then come back to discussion. From now onwards, when I say market, I always mean what? The stock index. Enna right or not? Now let's go understand a little bit about the index. Nothing great concept, very very simple concept only. Concept of index numbers we had in what? School days. Can I proceed? See. That is a new stock exchange which has opened. RSE. What stock exchange here? RSE. What's the name? Rajagopal Stock Exchange. Exchange name is what? Rajagopal Stock Exchange. Can I proceed now? The two shares, security A, security B, listed. A stock exchange is where shares are traded. It's a market. It's what? A market. Yes or no? In that market, how many shares are there? Two shares, A and B. So, suppose it was listed today only. It is the exchange open immediately. Listed what? Today only. RS Unlimited, SSR Limited. Adjust pannikum. Okay. So, I have what? Two shares here. Okay. Now, listen here carefully. A Limited company is having 10,000 shares trading at 80 rupees. How much rupees here? 80 rupees. B Limited is having 5,000 shares. First trade, that is anything, okay. No names here. A, B, that's all, okay. So B is having 5,000 shares. It is trading at, suppose, 60 rupees. Can I proceed or not? No. Tell me. Market capitalization means number of shares into market price per share. Accept or not? No. So it is 10,000 into what? 8. Gives how much rupees? 8 lakhs. 5,000 into 6 gives you what? 3 lakhs. Today the market wealth is 11 lakhs. Everybody following or not? This is today. Okay, today. Please. This 11 lakhs is given an index. First day index I given as 100. I give the 11 lakhs an index of what? 100. Okay. The stock market opened with the index of what? 100 on the first day of its business. Can I say or not? Now, tomorrow on the second day. Okay, please. A and B. The share price will remain same or can change? Can change. Every day share price goes up and down. Tomorrow suppose this 10,000 shares is trading at 90 rupees. How much rupees here? 90 rupees. Okay. And this 5,000 shares is trading at 75 rupees. That's okay. Yeah. Can I proceed now? Don't be playful. Listen. Okay. Now. Morning I took IPCC class here. Today very silent. Same thing you continue. Can I proceed? Now. 10,000 into 90, what's the amount? 9 lakhs. 5,075 is how much amount? Evalapa? 3 lakhs? Don't talk. The market become how much here? 12 lakhs 75,000. What the exchange does is very simple. 11 lakh represents 100 index. Now, what is 12 lakh 75? It is 100 into 12 lakhs 75 divided by 11 lakhs is going to give me how much here? 100 into, that is 100 is 11 lakhs now. What is 12 lakhs 75? 100 into 12 75 by 11 lakhs. Number, yeah. Point la solla, just tell me round off. 100 and 116. 116. Now what happens is, yesterday the index closed at 100, today the index became what? 116. Yes or no? No. One more day, I'll just conclude. The third day. Okay, please. Third day, security A, B is there. 10,000 share. Suddenly there is some news in the market. Market crash. The 90 rupees share becomes 60. Please. The 5,000 shares becomes, for example, 40. Tell me how much going to be here? 6 lakhs. And then becomes what? 2 lakhs, sir? What the market cap? Okay, I'll write it here. 8 lakhs having now. Now, 160 represents what? 12 lakhs 75. What should be 8 lakh? Next index or not? Now, I'll just do it here. It is 116 into 8 lakhs divided by 12 lakh 75. Everybody following or not? What is the number here? What is the 70? The point is 73 points. Please, 73 points. Very simple. You have heard in the news and all, no? Today Sensex closed at what? 20,100 points. Increased what? 23,000 points. Or decreased what? 18,000 points and so on. Index is moving up and down. Yes or no? Why index is moving up and down? Because the share price inside is going to be moving what? Up and down. That's point. Yes or no? Now, to put it simply, 100 became 160. 160 became what? 73, because the market is one day performing well, another performing what? Not well. The market varies or not. With this I can calculate the return and standard deviation. Instead of measuring the entire market value in what? Rupees, they put it in what? Index. Okay. So the index movement can measure the market return movements. Everybody following or not? I'll give a simple example. Now see. Did you first understand what do you mean by index or not? Okay. Index captures the movement of all the securities in the market. Point number one. Yes or no? It captures the movement of what? All the securities in the market. This is very index concept. Now, let me give a small example. See. Index dividend percentage return. Okay. See. We have year. Year 0, year 1, year 2, year 3. All this we'll be doing once again in sharp single index model later. Just year 0, 1, 2 and then 3. Listen here. Year 0, an index started with suppose 18,000 points. How many points here? 18,000 points. Okay. There's 100 over number of years will write to 18,000 points or not? Now, year 0, suppose index started with how many points here? 18,000 points. First year, it increased to 19,000. Next year it decreased to, that is, not so much here, decreased to what? 18,500. Last year it went to 19,200. Ennappa, right or not? Okay. Now this is index movement. This is what? Index movement. Okay. Now in the index all the companies are there or not? All these companies would have declared some dividend every year or not? Now, if I average over the dividend, I get the average dividend percentage on the market portfolio. Yes or no? So, all the shares in the market has given me in the first year a dividend of 3%, second year a dividend of 4%, third year a dividend of what? 1%. Everybody fine order. So, this is also a dividend yield given by what? The companies. Right or not? Now, I want to find out the return. Now, my question is, this is the dividend yield of one company or all companies? The dividend yield of what? All companies. How to calculate the dividend yield of all companies? We'll discuss in future chapter later. There's a problem for that separately. Everybody follow or not? So, how a company we can calculate a percentage dividend? For all companies also can calculate what percentage dividend is the dividend yield of the portfolio. What portfolio? Market portfolio. Right or not? Now, this is like a share price movement. TCS share can increase from 1,500 to what? 1,800. Increase from 1,800 to 2,000. Drop from 2,000 to what? I'll say 1,000. It can possible or not? So how TCS share can move up and down? The entire market portfolio also can what? Move up and down. For share we have share price. For market we have what? Index. You know what I'm saying? Market portfolio, I have my portfolio of market. If I want to know the price of the market portfolio, there's nothing but what? Index only. Index moves up. My market portfolio price has what? Gone up. Moves on means what? The price has gone down. It is very simple. The index derives the value only from the market portfolio's value. You know right what I'm saying? In that case, very simple. How we have a share price for individual share, I have an index for what? The market portfolio. Is it accepted? Yes or no? In that case, we always saw that return is year end price minus year beginning price divided by year beginning price plus a dividend yield. Now, dividend is given as percentage itself, so don't add it to the numerator there. Can I say? Now, for example, first year if you see, what is year end price? What is year beginning price? 18,000. Suppose I invested 18,000 rupees and bought all the shares of the market. At the end of the year, all the shares become how much? 19,000. I have a capital gain of 1,000 rupees or not? Either we call as points. We call as what? Points. So I have earned how many points? 1,000 points. By investing how many points? 18,000. If you see the return, 1,000 divided by what? 18,000. Tell me the percentage, yeah. 5 point? Okay, 5.55%. So the index has given a capital gain of 5.55. The shares index has given what? 3% yield. My return index is going to be how much here? 8.55 is the first year return from the market portfolio. Enna right or not? Respond yes or no? No. Second year, 19,000 index crashed to what? 18,500. I have gained the last point. How much index I lost? 500. On how much here? 19,000. So it is 500 divided by what? 19,000. Can tell me the percentage here? Minus 2.63 percentage. I have a dividend of 3. I have a loss of what? Minus 2.63. What's written here? 0.37. 4. That is 4. Sorry. Sorry. 1 point. Okay, 37%. Put here. Don't get confusion. Can I proceed? No. Third year, 18,500 becomes what? 19,200. The index has gained how many points? 700 points. From where? 18,500. Tell me what the percentage here? 1%. Clear as lupa. 3 point. Plus what? 1 gives you what? 4.78%. Yes or no? No. How a share has got different years return, either return from the market portfolio. Got or not? This is having what I expect. I expect 8.55, 4.78, 1.37. I expect average. So the expected return on market portfolio is what? The average return. Respond yes or no? What is the risk here? The standard deviation of this becomes what? A risk. So now we can understand that how an individual security can have a risk and return. So too what? A market portfolio also can have what? Risk and return. Which normally they try to measure through what? The index movement. Now are you able to understand the importance of index or not? Index. So now with this we have concluded that discussion about what? Stock index. Let's come back to the theory. Can I proceed or not? Now see. Now all my wealth, the entire country's wealth will be either invested in what? Risk-free asset or in what? Market portfolio or in the combination of both along with the borrowing. Right or not? No. This portfolio consists of almost all the securities and this portfolio should be having a return. Yes or no? The return of this portfolio is called as RM. How to calculate return on market portfolio? Now I have showed the index movement as well as what? Dividend yield inside the stock index. And how to find out the risk here? Risk is what? Standard deviation of the index movement. Everybody follow what I am saying? So how a single share can have a return and risk? Like the market portfolio too will be having what? Return and risk. The return is what? Sigma M. The risk is what? RM. That is what you are giving us a terminology. Respond yes or no? See, here, let us see one more issue. In India, there can be thousands of shares listed in stock exchange, or no? Around 900 to 1,200 shares are on an average going into what? Big stock exchanges, right or not? Don't think that the index is constructed for all the 1,000 shares. We have two index, namely Sensex and then what? Nifty, which are very famous. Other index also there. Sensex and what? Nifty. Nifty consists of a portfolio of only 50 shares. How many shares here? 50 shares. Sensex consists only a portfolio of how many shares here? 30 shares. Now wonder, sir, how we can call this as what? Diversify. What happens is, this 50 shares almost corners 90 to 95% of the country wealth. Everybody, are you following? If you have the Axis Bank share, ICICI, or a TCS, or Infosys, or a Reliance, or a Tata, everything what? You had, and also add what? MTSG cash share, you need not add because in the ocean, if you put water, a drop of water, it still remains ocean only. No, no. See, I am not demeaning any company. I am seeing only the size. I am seeing only what? The size. Some companies are 15 crore worth company. Others may be what? 100 crores or 200 crores. So we have big companies, mid cap, small cap, etc. Yes or no? Normally, what they felt is that it is not necessary to construct the index for all the shares because most of our money is only in what? Selected shares. That only should go into what? The index. What share should go into index? Stock exchange determines. Everybody, are you following what I am saying? So that means it is much more made simple. When I say market portfolio, don't think that there are 1,000 shares in the portfolio or 1,500 company shares in portfolio. If you take US as S&P 500, In that case, going to be how many companies? 500 companies only will be there inside what? The given index. Are you all follow what I am saying? So in that case, selected companies is going to corner what? Chunk of the wealth. So they felt that there is no use in constructing a 1500 share portfolio and what a 500 share portfolio because both portfolios are going to be almost what? Same because an MTS share price movement can never influence the index. Because an ant cannot pull an elephant. I am not only saying MTS, all the companies which are in what? Small cap, they are also contributing to market, no doubt about it. But the entire country is well, the size of the company gets caught only in what? Few shares. That's why I said, now this CML, SML becomes very simple because I need not see about so many company shares. I have to deal only with what? 50 or 100 company shares to understand the entire market. Are you following what I am saying? Now understand how they are making entire investment process what? Simplified. Now why I am discussing all this because discuss further concept. You should not have any doubts or questions about the issues or not. Hence I am discussing along with the assumptions. Now the issue is, this is called as market index, market portfolio. The portfolio is having what? Risk and then what? Return. This is very important. Now let me come to some formulas or equations and then go for the next conclusion. Can I proceed? Now, what is the efficiency frontier? Tell me. I'll dictate notes for this, all this later. Tell me, what is efficiency frontier? It is a portfolio consisting of risk-free asset and market portfolio. Yes or no? This is the answer. Now the CAL, capital allocation line, has become what? Capital market line, where you put the entire money either in market portfolio or what? Risky asset, risk-free asset. Don't think market portfolio means what? All the 1500 shares. Even if you invest in what? 50 companies, large company shares, in the proportion of the stock index, I am investing in the market portfolio. Everybody respond, yes or no? So now my efficiency frontier consists of investments consisting of what? Risk-free asset and invest in the market portfolio. Respond, yes or no? This is a portfolio. We call this as two-fund theorem. You call us what fund theorem? Two-fund theorem. Fund 1 is risk-free asset. Fund 2 is what? Market portfolio. I put my money in two funds, risk-free and then what? Market portfolio. So it is called as a portfolio consisting of two funds, risky and risk-free funds. Yes or no? This portfolio should be having a return and risk. In the CML, there should be a return and risk or not. So, what is the return of the portfolio? Risk of a portfolio. Let's further discuss and then arrive at some conclusion. Now tell me, what is the return of a portfolio? First stop. Are you all tired? Listening. Now please, bear with me. Today's class, okay? Put hard effort. Then next class onwards, you start doing problems. But understand that this is how one should be understanding what? Entire subject. I cannot teach otherwise. This is how it should be taught. Now, listen here. First, I will consolidate and then ask you the question. Okay? Now, all of you, now attentive or not? Yes, very simple. In 2 minutes, nothing great. I only discuss small issues. Okay? 2 minutes will consolidate. Number 1. You and me have different efficiency frontier, same efficiency frontier. Yes. Then all of us will have the same efficient portfolio. Yes, the CA will be same for all of us or not? Yes, entire will be in that portfolio or not? Yes, all other securities will be overpriced. Yes, the price drops due to lack of demand. Yes, all securities put in the portfolio or not? Yes, now the portfolio becomes what? Market portfolio. How a portfolio can have a return and risk, market portfolio also can have what? Return and risk. How to find return and risk for the entire market? Using the index. Using what? Index. That's why I come to the concept called as what? Index. So index moves up means I'm having a capital gains. Moves means what? I'm having a capital loss. Apart from that, companies inside index declare dividend. They become a dividend of the index also. Yes or no? So simply how I have a return and risk for the portfolio, I have a return and risk for what? Index. Up to this, are you following not? And that way I said that index not don't think they'll be having 1500 or 1000 company shares. It consists only of what? Top 50 or 100 or 500 company based on a stock exchange where the entire wealth is cornered. Are you following what I'm saying? So we need not track the full market. This we will track what a few companies in the market. We'll be understanding about the risk return profile. Are you following now? Now, so here only I discussed further. Now, what is my efficiency frontier? I asked now. What is my efficiency frontier? It is a portfolio consisting of risk-free asset and market portfolio. We call it what theorem? Two-fund theorem. One fund is what? Risk-free. Another fund is what? Market portfolio. My money can be in either this fund or this fund or a mix. This is a portfolio. Yes or no? Yes, this two-fund portfolio should be having a risk, should be having a return. We come back to the same old story. What's the return of a portfolio? Weighted average return on the market index. I'm not having what? Two portfolios, market and then what? Risk free. So these two if I combine, what return of the portfolio? Weighted average return of the individual securities. Ennappa return or not? It is very simple. See. Return of RF and what? Market portfolio. This itself is a portfolio. That's what I'm saying. There is one portfolio called as market, another is called as what? RF. These two combine again what? A new portfolio. This one I'm calling as portfolio now. I don't know. Now two fund portfolio. Can I proceed? Now tell me the columns here. Security, proportion. Are you following up? Now tell me what is security? RF and then what? Market portfolio. What proportion? WRF, WM. Here I wrote WS in CAL. I now start writing what? WM. Boldly I can write what? WM because this market portfolio only. Yes or no? Now, what is the return here? RF. Return is what? RM. Return means return on market portfolio. And what is this here? WRF into RF. This is what? WM into RM. That means the return of portfolio is equal to WRF, RF plus what? WM, RM is a return of a portfolio. Up to this, everybody, are you following or not? Okay. Now, this portfolio not only has a return, we having what? Risk. Sigma P, the risk of the portfolio, the correlation between risk-free asset and market is what? Zero. What am I saying? Same thing. It is going to be what? WM sigma M. Right or not? I already proved earlier. Don't make me prove once again. It is what? A portfolio consisting of risk-free asset and risky asset. The risky is what? Sigma P is equal to proportion of risky asset into what? Standard deviation. Can you accept or not? So sigma P is equal to WM sigma M. Up to this, are you following what I am saying? Can I proceed? Now, from this, I can rearrange and write WM is equal to what? Sigma P divided by sigma M. Is accepted? Only a rearrangement of formula, that's all. Can I proceed? Now, let's come to the return on portfolio. What return on portfolio? WRF plus RF plus WM plus RM. Yes or no? Now, weight of risk-free asset is 1 minus WM. If you have 1 rupee, we invest what? 80 paise in market, 20 paise is what? Risk-free. Yes or no? What I am saying? So WRF can be written as 1 minus WM. Right or not? Now, listen to this particular equation. Now, please tell me once again. Return of portfolio is equal to 1 minus weight of market. Gives you what? Weight of risk-free asset into what? RF plus WM into RM. Any accept or not? Now, please rearrange. Return of portfolio is equal to RF minus WM RF plus WM RM. Right or not? Now, W1 RF plus WM RM. Right or not? Now, rearrange. Return of portfolio is equal to RF plus WM can be taken outside or not? Yes. Plus WM into RM minus RF. Everybody, yes or no? It is RF plus what? WM into RM minus RF. It will be written on the portfolio. Yes or no? Now, next is which is equal to RF plus what is WM? Sigma P divided by sigma M into what? RM minus RF. This is what they call as capital market line equation. What equation here? Capital market line equation. Everybody up to this, are you following the equation or not? I'll tell the utility later. Did you understand the equation or not? Now, tell me what is the equation? RP. RP means what? Return from portfolio is equal to what? RF plus sigma P by sigma M into RM minus RF. Ennappa, right or not? Now, the logic is very simple. Then we can just proceed further. See. How much return I want depends on the risk I take. For a given level of risk, only return is going to be generated. So no, that's the objective of the chapter. They are going towards objective. What is the objective of the chapter? Yeah, to find out a required return for a given level of risk. Yes or no? Now, see, how much return I should ask on a portfolio? Question says no. It all depends on the risk I am taking. Depends on what risk I am taking. Okay. Now, see, if I don't want to take any risk, I should expect RF. If I don't want to take any risk, now again say, what is the objective of this chapter? For a risk you are taking, how much you should ask? That's the question. The entire chapter focus is to discover a discount rate. What I am saying? For risk you are taking, how much you should ask? Is the question or not? Now, I say, I don't want to take any risk. I don't want to take what? Any risk. Ask how much return? RF. Okay. Now, I say, I want to take the market risk. I want to take what? Market risk. That means I am investing in which company shares? The entire market portfolio. You would understand my question or not? See, I want to now take the market risk. I want to take what risk? Market risk. Taking a market risk, suppose I want to take a TCS company risk. What is the meaning of that? I invest in what? TCS shares. I want to take MTH risk. I should invest in what? MTH shares. Like that, I want to take what? Market risk. Invest in what? Entire market portfolio. Yes or no? Now, if I want to take a risk of sigma m, I want to take a risk of what? Sigma m, the return I should ask is RM minus RF. And RF is a return for taking what? Zero risk. RM is return I can get for taking what? Market risk. RM minus RF is a premium I should ask for taking what? Market risk. Yes or no? But if I take a risk more than the market risk, my sigma p is what? More. I should ask more premium, less premium, more premium. The sigma p times what? The market risk becomes what? My security risk premium. Everybody yes or no? If the p is what? Less, I should ask what? Lesser premium. Everybody following or not? From this, understand what happened is, these persons, CML, CAPM and all, has agreed one thing. Market the benchmark for asking return. You should ask return. I should ask return keeping what as a benchmark? Market. If we invest in the entire market, it is giving you so much return RM. Yes or no? It is having a risk of what? Sigma M. For sigma M, if you can ask RM minus RF as premium, if you take for this share a sigma P risk, you ask what? Sigma P times the market risk premium. Yes or no? One thing we have accepted, another thing we are deriving. We are accepting what? Market efficient. We are accepting market as what? Efficient. This RM is the correct return one should get for taking a market risk sigma M. The RM is a return anybody should get by taking what? Sigma M. If you say, sir, this itself not correct, I cannot proceed further and stop my class. The reason is, the assumption, market is what? Efficient. When market is efficient, what return is giving is an efficient return. You cannot generate a better return than that. Are you following or not? This is the assumption here. Either we can generate, cannot generate is $1 million question. Some say it is efficient, another is what? Inefficient. We always discuss these things based on what? Efficient market. Now, assumption. If I invest in the market portfolio, I can get this return. Now, that means if I invest in some other share, not being a market portfolio, how much I should ask? Question arises no. In that case, that share should be having a risk. It is called as what? Sigma P. You can call it what? Sigma P. It can be a single share or what? Portfolio share. It will be having a risk or not. That risk done. So many times the risk of RM minus R should be asked as what? The premium for the particular share risk. That gives me the required return for a given security. Everybody following or not? This week, as what line here? Capital market line. The small tinkering will take place when you go for what? CAPM later. Everybody following up? Now, I'll explain this diagrammatically before I give you the notes in this regard. Now, so scale go. Yes, yeah. Daily or pudu scale. Yes, yeah. please. Now, can I proceed? Okay, please listen here. Now, this is a market portfolio, right or not? This is risk-free asset, right or not? Okay. If I put my entire money, please stop talking. If I put my entire money in this market portfolio, my return is RM, correct? My risk is sigma M, correct? If I put entire money in risk-free asset, my return is what? RM. The risk is what? 0. For increasing level of risk, by combining RF and RM, I'll be sitting in one of the points in the line, correct? Suppose I put 90% of the money in RF, 10% in what? Market portfolio. The return is going to what? Increase for this particular risk. Yes or no? Now, this line we give a name called as what? Capital market line, where it is a portfolio consisting of risk-free asset and what? Market portfolio. Respond yes or no? Now, every one of us is now agreeing that this line is going to be the efficiency frontier. It's going to be what? Efficiency frontier. There cannot be any other line above it is a presumption. Right or not? Now, suppose I want to invest in a share. I want to invest in a share which is having a risk of sigma S. I'm having a risk of what? Sigma S. Having a risk of what? Sigma S. And even call a sigma P also we can call in this case sigma P. I'm going to invest in a portfolio having a risk called as what? Sigma P. For taking this risk, how much return I should ask? Question arises now. Now, I am going to invest in a portfolio. The portfolio may consist of an MTH gas share and a Reliance share. For example, okay, it is not a market portfolio, it is what? Some other portfolio. I am going to invest money in that portfolio. Accept or not? Now, that portfolio will be having a risk or not? What is the portfolio? Sigma P. My question is, for this portfolio, how much return I should ask? Question arises now. Whenever I make an investment, I should ask for the return for the investment or not. How much I should ask? I should ask return here on this line, because we all know that the CML is the efficiency frontier. I should always sit on the efficiency frontier. Got what I am saying? In that case, for the sigma P, this should be the return I should be asking. Yes or no? Tell me, what is this return? It is very simple. Return is what? Very simple. For going here, I want RM minus RF. For sigma M, I want what? RM minus RF. So RM minus RF is what? Is a premium I want for what? Sigma M. Now, but this is for what? Sigma M. I want the premium. Yes or no? But my risk is sigma M less than sigma M less than sigma M. Is what here? Sigma P into what? Sigma P gives you the risk premium. I should be asking yes or no? That risk premium added to what? RF. I'll be getting this particular number required return. Right or not? Suppose another portfolio is there, I can call it this portfolio 2. This portfolio 2 is having a risk more than what? Market risk. More than what? Market risk. Answer my question. In this case, I should ask more or less or more. My point should be somewhere here. My point should be what? Somewhere here. How to find out the return required? Very simple. For taking the sigma M, I want RM minus RF premium. Yes or no? For taking sigma P2, I require what? Sigma P2 by sigma M into RM minus RF. The premium becomes more than the market premium. Respond yes or no? So, when I think the market has an equilibrium, I know how much to ask for any security in the world. Yes or no? So, we take what as a benchmark? Market. That's why these models are called as index models. Called as what? Index model. Later, this only gets converted into CAPM, where the concept of beta will be introduced. Right or not? Please tell me yes or no. With this, we complete this concept called as what? Capital market line. Almost most of the discussion required for CAPM also has been what? Discussed, except for a few changes to be discussed later. So, one of the hard work over. Now, please. As I have a brief notes in this regard, I am dictating notes for you to get a clarity and then go for the CAPM. Before that, don't think I have discussed too much. I discussed only too little. I discussed only what? Too little. Let's see what too little we have discussed. Okay, number one. You and me have, I'm going to starting point. You and me have same efficiency, different efficiency frontier. When you have same efficiency frontier, both of us will be having the same tendency. We all select what? Same efficient portfolio. In that case, everybody in the country will invest either in risk-free asset or efficient portfolio. Due to this, the wealth of the countries are inside what? Efficient portfolio. I don't know. Suppose out of the 10 shares in the market, 3 is the efficient portfolio, other 7 will be non-traded. Yes or no? In that case, what happens here? The price will decrease, the return will increase. They all enter into what? Efficient portfolio. Ultimately, the entire market becomes what? Efficient portfolio. It is now called as what? Market portfolio. Now tell me two-fund theorem. You invest the money either in what? Risk-free asset or in what? Market portfolio. This is called as what theorem? Two-fund theorem. This is efficiency frontier. Yes or no? Any clarity? Now, in that case, the market portfolio will be having a risk or not? It is going to have a return or not? The return on market portfolio is called as RM. The risk is called as what? As sigma P. How they calculate? Using the index points. That's what I'm saying. Using what is the stock index points. So now the market portfolio is having a return RM. Risk is what? Sigma P. The risk-free asset is having what? Return RF. Risk is what? 0. When I have a combination of both these two, I'll form a portfolio of two funds. Yes or no? So the return of that portfolio is weight of RF plus RF plus what? Weight of RM plus RM. Yes or no? This is going to be return of the portfolio consisting of what? Risk-free asset and market. This is a return of an efficiency frontier. This return is going to be what? Efficiency frontier. Up to this following not. Now, the risk of this portfolio is sigma P is equal to what? WN sigma M. Otherwise, WM is equal to what? Sigma P by sigma M. How much I invest in market portfolio depends on how much risk I want to take. Everybody yes or no? Now, next is, I rearrange the return of portfolio. RF is 1 minus WM plus RF plus this. If I rearrange, I'll be getting RF plus WM into RM minus RF. WM is what? Sigma P by sigma M. This line we call as what? Capital market line. We call as what? Capital market line. This is something different than SML. We'll discuss in a later stage. Yes or no? Now, ultimately, you tell me the equation. Capital market line. Return of any portfolio should be what? RF plus the risk of the portfolio divided by the risk of the market into RM minus R is what we call as what line here? Capital market line. So how much return I should ask depends on what? The risk I am taking. How much I should ask depends on what? RM minus R is a premium a risk averse investor wants for taking what? Sigma M. So what you should want for taking sigma P? It depends on sigma P times the market risk premium gives you what? This number. Everybody following or not? So we prove this to the diagram. If I'm in this side, I'll ask for a lesser return than market return. If I'm on the other side, I'll ask for what? More return than market return. If I'm exactly on market, I'll be asking for what? Market return. 0 means what? Risk-free return. Is what is a CML all about? Respond yes or no. What is the difference between CML and CAPM will be the next stage of discussion. Are you following on? In an exam question can be a CML question, can also be what? A CAPM question, even can be CAL question. You know what I am saying? If properly in a CAL, sigma M will not come. It becomes sigma S. Are you following what I am saying? So it will be differentiating and what? Answering the questions. Now, let's have the notes in this regard. Don't get annoyed. Then I'll give an introduction to CAPM today. Leave it. Tomorrow onwards, don't be absent to the class. Be present. Start doing lot of problems. There are 8 to 10 sums in one go. We'll be able to complete quickly. Anyway, can I proceed or not? Write down. Next. So, where you have stopped there? Assumptions over. Write or not? Write down. Next. Concept of capital market line. Concept of capital market line. Concept of capital market line. Point number 1. Point number 1. When all investors have similar risk return expectation, when all investors have similar risk return expectation, they all should have the same Markowitz efficiency frontier. They all should have the same Markowitz efficiency frontier. They all should have same Markowitz efficiency frontier. They all should have the same Markowitz efficiency frontier. Can I proceed? Now, point number 1 or 2 or 2. if the efficiency frontier is same, if the efficiency frontier is same, then the CAL, what is the meaning of CAL? Capital allocation line. Then the CAL of all the investors should also be same. Then the CAL of all the investors should also be same. Then the CAL of all the investors should also be same. The CAL of all the investors should also be same. Which means the point of tangency, bracket la what the point called? Efficient portfolio, which means the point of tangency, in bracket right, efficient portfolio, bracket close, is also same. The point of tangency, bracket efficient portfolio, is also same. Can I proceed or not? Next, point number 3 or 4? 3. Suppose the market has 10 securities. Suppose the market has 10 securities and the efficient portfolio consists of 3 securities A, B, C, and the efficient portfolio consists of 3 securities A, B, C in equal proportion. The efficient portfolio consists of 3 securities A, B, C in equal proportion. The proportion need not be equal. I just gave an example in equal proportion. Then the entire country will invest. Then the entire country will invest either in A. What is first A? Risk-free asset. Entire country will invest either in A, risk-free asset, B, don't say market portfolio, B, efficient portfolio, invest A in risk-free asset, B, efficient portfolio, bracket la A, B, C in equal proportion, B, efficient portfolio. What efficient portfolio? A, B, C in equal proportion, A, B, C in equal proportion, C, or a combination of both. C, or a combination of both. I will dictate here. C, combination of both. And D, borrow and invest in efficient portfolio. D, borrow and invest in efficient portfolio. D, borrow and invest in efficient portfolio. Respond. Are you all following or not? Next. Point number 3 or 4? 4. The risk-free investment and risk-free borrowing. The risk-free investment and risk-free borrowing cancels out each other. The risk-free investment and risk-free borrowing cancels out each other, resulting in the entire wealth invested in, what? A, B and C. Resulting in the entire wealth invested in A, B and C. Entire wealth invested in A, B and C. Everybody, I have the clarity or not? Invested in A, B and C. Next, point number 3 or 4 or 5? 5. Now, other securities. Now, other 7 securities. In our example, now other 7 securities will not have demand. Other 7 securities will not have demand. Other 7 securities will not have demand. Hence, the price reduces. Other 7 securities will not have demand. Hence, the price reduces. which increases. When price reduces, which increases what? Return. Price reduces, which increases return, and make them, which increases return and make them efficient. Which increases return and make them efficient. Full stop. They also enter. They also enter. Tell me, they also enter what? Efficient portfolio. They also enter efficient portfolio. They also enter efficient portfolio, which now consists of. They also enter efficient portfolio, which now consists of. Which now consists of what? All the securities. Which now consists of all the securities. Which now consists of all the securities. It is now called, full stop, it is now called what? Market portfolio. It is now called market portfolio. It is now called market portfolio. Are you following? So much you have to understand a market portfolio. Yes or no? So we frequently use RM in the IPCC and all. No, RM means market portfolio. What is a return? What is a market portfolio? Now only we'll be having what? A full idea how it works. Are you following not? Next. Point number 4 or 5 or 6. Point number 6. Point number 6. This market portfolio will have a return under risk. This market portfolio will have a return under risk. I mean, a portfolio can have a return and risk. This should also have what? Return and risk. This market portfolio will have a return and risk, which is expressed as RM and sigma M. Which is expressed as RM and sigma M. Which is expressed as RM and sigma M. What is RM? Tell me. Return on market portfolio. What is sigma M? Standard deviation of market portfolio, risk of market portfolio, expressed as what? RM and sigma M. Can I proceed? Next. Point number 7. Point number 7. The price movements of market portfolio, the price movements of market portfolio will be understood through. The price movements of market portfolio will be understood through what? Index points movements. Will be understood through index point movements. Will be understood through index point movement. About index, I'll type and give you the notes. Can I proceed? It will be understood through index point movements. And the dividend yield of the shares in market portfolio, and the dividend yield of the shares in the market portfolio will be published by stock exchanges. And the dividend yield on the shares in the market portfolio will be published by stock exchanges. That you need not calculate. They'll give you the data. How to calculate, you'll be seeing in futures chapter later. Okay. So it will be given by stock exchanges. Will be given by stock exchanges. You know, I don't know. Because what is the return of a share? What is the return of a share? Year end price minus year beginning price. This is going to be what? Year end index minus year beginning index and so on. Respond yes or no. Write down. Next. RM is equal to, continue writing, same point. RM is equal to year end index minus year beginning index. Year end index minus year beginning index. Enniya purinjudha? Year end index minus year beginning index divided by what? Year beginning index. Divided by year beginning index. This is one term. Go right hand side separately. Plus dividend yield. Plus dividend yield. Since they gave us straight away as percentage, we need not go to numerator plus what? Dividend yield. Year end index minus year beginning index divided by year beginning index plus what? Dividend yield. Gives you what? RM. Can I proceed? Next. Sigma M is square root of sigma m is, if you want you can write square root of, square root of Rm minus Rm bar divided by n. Either written on market value every year. This is what? Average return. Square root of Rm minus Rm bar divided by n. We calculate this using beta later, okay? Rm minus Rm bar divided by n. Or when you have probability, tell me what it is here. Sigma p into Rm minus Rm bar. Square root. Sigma p into Rm minus Rm bar. Sigma p into Rm minus Rm bar. We know how to calculate Rm as well as what? Sigma m. This is called as what? Sigma m calculation. So sigma p into Rm minus Rm bar. Everything will be doing problems later. Everybody following or not? Now. Next. Point number 6 or 7? Point number 8. You know, last 2 points I will escape. Okay, point number 8. Please. Shh. Point number 8. Now, the entire market, will invest their funds, either in risk-free asset, or market portfolio. The entire market will invest their funds either in risk-free asset or market portfolio or combinations. Risk-free asset or market portfolio or combination. That is all both or combination. This is called two-fund theorem. This is called two-fund theorem. In short notes, I can be asked here. This is called as what? Two-fund theorem. Next, point number 7 or 8 or 9 or 9. The return of the above portfolio is as follows. Security, have the column security, proportion, return, weighted return. Security, proportion, return, and then weighted return. Security, proportion, return, and then weighted return. Security RF market portfolio. I am going to invest in risk-free asset and then what? Market portfolio. RF market portfolio. Proportion WRF WM. WRF WM. Return RF RM. Return RF RM. Do you know how to calculate RM? Yes. Just now point number 6 I dictated. Yes or no? So return is RF RM. Weighted return WRF into RF. Weighted return WRF into RF. WM into RM. WRF into RF plus WM into RM. Right. RP. What is RP? Return on portfolio is equal to RP is equal to WRF plus RF. WRF plus RF plus what? WRM and WRF into RF plus WM into RM. WRF into RF plus WM into RM. W1 into RM. Can I proceed? Next. Same line you write. The risk of the portfolio is, same point you continue. The risk of the portfolio is, sigma P is equal to WM sigma M. Sigma P is equal to WM sigma M. Sigma P is equal to WN sigma M. Therefore, WM is equal to what? Sigma P by sigma M. WM is equal to sigma P by sigma M. Can I proceed or not? Now, point number 9 or 10? 10. capital market line equation. Point number 10, capital market line equation. One of the exam question is differentiate between CAL, CML and SML. What I am saying? So, you know, gradually moving na capital market line equation. Okay, capital market line equation. Now, underline that, right? RP is equal to return on portfolio is equal to 1 minus WM. Now, weight of RP is what? 1 minus weight of market na 1 minus WM. Understanding and writing or not? RP is equal to 1 minus WM into RF. 1 minus WM into RF plus WM into RM. 1 minus WM into RF plus WM into RM plus WM into RM. Now, I want a confirmation. Stop writing. What is this here? Risk-free into weight of risk-free plus market security into weight of market. Other written portfolio. So no. What is weight of risk-free asset? 1 minus weight of market asset. Ennappa right or not? That's what I written. Next, RP is equal to open the brackets RF minus WMRF minus WMRF plus what? WMRM plus WMRM. RP is equal to RF plus, take WM outside, RF plus WM into RF plus WM into RM minus RF. RF plus WM into RM minus RF, which is equal to RF plus. What is weight of market? We had earlier written, no? What is make of market? Sigma P by sigma M. RF plus sigma P by sigma M into RM minus RF. RF plus sigma P by sigma M into RM minus RF. Can I proceed or not? Now. Thus, continue. Thus, the equation of CML is RP is equal to RF plus sigma P sigma M into RF plus sigma P sigma M into RM minus RF. Sigma P sigma M into RM minus RF. What here? Sigma P by sigma M into RM minus RF. What here? What is it? Yeah. Okay, sigma P by sigma M into RM minus RF. You understood or not? That's important. Yeah. Substance okay or not? Next. Last point. 10 or 11? 11. The objective of this chapter. Now only we started the chapter. What is the objective of the chapter? Discovery of discount rate. So, for a given level of risk, how much would ask us what return? For understanding that so much has been discussed from Markowitz to what CML. Yes or no? Right now, the objective of this chapter, please. The objective of this chapter is to understand. How much return we should ask. The objective of this chapter is to understand how much return we should ask. How much return we should ask for taking. How much return we should ask for taking a given level of risk. How much return we should ask for taking the given level of risk. Which is answered by CML. Okay. Next line. Point number 11 or 12? 12. This is my last point. Okay, believe me. Point number 12. 11 is splitting, that's all. Okay, point number 12. Okay. Now, if we invest in risk-free asset, we should expect RF. if we invest in risk-free asset, what we should ask here? We should expect what? RF. We should expect RF. By investing in market portfolio, by investing in market portfolio and taking what risk? Sigma M risk. By investing in market portfolio and taking sigma M risk. When I invest in market portfolio, what is my risk here? Sigma M. By investing in market portfolio and taking sigma M risk, the risk averse investor, he will ask premium or not? Risk neutral will not ask premium, other person will be paying the money. So no, the risk averse investor will ask a premium of, the risk averse investor will ask a premium of what? RM minus RF. Will ask a premium of RM minus RF. Hence, for taking a sigma P risk, the premium asked will be, for taking sigma P risk, the premium asked will be sigma P by sigma M. The premium asked will be sigma P by sigma M into RM minus RF. The premium ask is sigma P by sigma M into RM minus RF. Everybody, I have the clarity or not? No. This diagram no need to draw. We will do this in SML in a much more modified way. Everybody follow or not? Now, with this we have completed the concept as what? CML, capital market line. No. See, like a train journey we are moving here. We start with the risk return profile, please. With the help of that we moved into what? Markowitz. He helped you to find out an efficiency frontier. From there we saw capital allocation line, which helped us to move into what? Capital market line. From here I had to move into what? CAPM. Remember, I don't know. Now give the heading. Capital asset pricing model, very important area. Most of the exam questions are asked from the CAPM. Okay, give the heading. Capital asset pricing model. Please. Shh. Capital asset pricing model. Okay. See. Request. So much hard effort is put to explain all this. Dictative notes also. I could have easily given printed notes, but since the concept is difficult, when you write, the understanding becomes what? Much more clearer. Hence the note has been dictated. Now, one request is, you should go home and understand each and every point that is discussed. If you do that, I can say exam problem, not left hand you can just do it. Main problem in SFM is, now, jokes apart. Now, I'll say the main issue. Main problem in SFM is, students don't know what question they are answering. They'll give a question, we don't know how to handle it because we don't have a theoretical background or the conceptual background of the entire issue. Are you following not? Portfolio, we calculate one RP down. What is RP? RP is equal to what? This RP only he called, let us K in SML. Okay, return is equal to what? R plus sigma P divided by sigma M into R minus R. One equation you got or not? Same thing, another person will say, they substitute RP by what? KE they call us, is equal to R plus what? Beta into R minus R. Will be said by what? CAPM. Another shop will say, it is K is equal to alpha plus beta RM plus sigma EA squared. What I am saying, in that case, same return discovery only, they find it different ways. Now, why I am discussing so deeply is, if you don't know RM itself, normally என்ன சொல்லுவோம் எல்லா புக்ஸ்லயும் ஆர்எம்னா market portfolio return. What is a market portfolio? How the return is calculated? Why they take it as what? Benchmark. What are the assumptions? Only when you know with such a background, you will be able to appreciate question and easily answer it. Now, importance of I am not teaching anything out of syllabus. All these are what? Part of the curriculum only. Are you following up? Now, Don't think entire subject will be like that. Once we escape this chapter, all the other chapters will be what? Much more simpler, but will be built on this chapter base mostly. I will follow not now. Next, give the heading capital asset pricing model. Okay. With this, I'll complete today's discussion. Okay, introduction I'll do and leave you. Capital asset pricing model. Next class, believe me, only calculator, no alphabets. Okay, next is capital asset pricing model. You all are inching to do problems or not? We'll do next class. Don't worry, capital asset pricing models. Okay, now, see, capital asset pricing model is independently given by three persons. Not that one gave, copy paste, another gave. Not like that, yeah. Three persons simultaneously came with that model. It came 10 years after Markovitch. Are you following what I am saying? Now, Sharp, Linter. These are the two main person, early person giving what? The capital asset pricing model. Sharp and then what? Linter. Or the person who are just pioneers in what? The capital asset pricing model. Apart from that, is a person called as Mosin, M-O-S-S-I-N. He also contributed what? To the capital asset pricing model. All these persons and trainer, the four person is what? Trainer. Sharp, trainer, Mosin and then what? Linter. These four persons published papers regarding what? The CAPM, and all the four said the same thing. Are you following what I am saying? Except for what? Some alternative differences, but predominantly what they said is what? Same. All the four were given what? Nobel Prize for the CAPM to make the stock market investment much more simpler and easier. Can I present or not? Now, let's see. In essence, I don't want to go into deep derivations. I'll tell you in what essence, what the model is all about, and then give you the notes. Okay, please listen here. When I complete this introduction, with the help of this introduction, 8 to 9 problems will be done. Most of them are examination sums. Are you following or not? Now, let's see the introduction to the CAPM. Okay, first, Markovitch said that when correlation is -1, risk can be reduced to 0. Through optimum proportion of A is equal to sigma B by sigma A plus sigma B. Proportion of B is equal to what? Sigma B by sigma A plus sigma B. So Markovitch says that I can even reduce my risk to what? 0 through optimum portfolio proportion. Respond yes or no? No. This has been proved wrong. They disputed that risk can never be reduced to what? 0. So this model classify the risk into two types. Classify the risk into what? Two types. One is called as systematic risk. Another is called as what? Unsystematic risk. Okay, I am now discussing about CAPM. A class of risk into two types: systematic risk and then what? Unsystematic risk. Okay. See, if I invest the money only in TCS shares, I am having risk or not? Answer yes or no? Because my entire wealth depends on that company performance alone. Right or not? If I invest the money in TCS shares and Infosys shares, I'm having risk or not? Risk is there. The risk what? Reduces. You have seen that diversification reduces what? Risk. Everybody accept it. Are you following or not? Now, if I invest the money in TCS Infosys share alone, I am only diversifying into IT sector, but that is also what? A risk. IT sector itself may not perform. Are you following what I am saying? So what I do is, I don't invest in TCS and what? Infosys. I invest in Axis Bank and ICICI Bank. That means what? I am now diversifying from IT sector to what? Banking sector. Now IT and banking together may fall. Yes or no? So I became afraid. I diversify further into what? Pharma sector. I invest in what? Rand banks. I invest in what? Pharma sector. I invest the money. So pharma also may fall. I became afraid. I invest in what? Iron and steel. Tisco. I just invest in what? Automobile. I can invest in what? Tata Motors, etc. Everybody following not. So what happens is, I invested in all the sectors, all the company shares. Now that means I am becoming well diversified, including gold, everything what I invested. I invest everywhere. Any asset is there in the world, I'll be an investor. For example, okay, now don't ask me whether I can have a wealth. Infinitely small investment can be made is an assumption. Sir, how can invest in all the companies? Sir, don't ask me, because investment can be made in what? Infinitely small quantity. With 100 rupees, I can buy the world. By having what? Small stake everywhere. Don't laugh. For that only, funds like index funds will come into picture. Are you following? Mutual funds, index, etc. We'll see that in the futures hedging later. Are you following up? So, in that case, I have diversified fully. All places I am having my legs and hands. Now tell me, I have zero risk. We cannot say, even if I invest in the entire market may crash. Yes or no? It happened in 2008-9. Don't ask how. It has happened. Every sector may not want to flourish. Entire market, government policy may be there, and inflation may be there, anything may be there. There are so many factors affect or not. So there's something called as macroeconomic factors. What factors? Macroeconomic factor which affects all companies, all assets. Are you following what I'm saying? In that case, even 100% diversification need not reduce risk to zero. Are you following? In that case, that means there are two types of risk: diversifiable risk and non-diversifiable risk. So no, diversifiable risk are those risks I can reduce through what? Diversification. Even after full diversification, still some risk is left out. Yes or no? The risk that could not be hedged by diversification, I call as what? Non-diversifiable risk. Yes or no? Okay. Systematic risk are the risks not coming from a specific company, is the risk to the entire system. If I invest in all the shares in India, still I have a country risk. What I'm saying? So the risk we call as what? Systematic risk. There's a risk that is applicable to what? Entire market. This risk can be diversified away? Cannot be. Even if I do full diversification, still there's an undiversified risk called as what? Systematic risk. Right or not? No. Unsystematic risk or company specific risk, or what? Company specific risk is specific to a particular company. Right or not? So for example, I invest in Infosys and what? TCS. There's a company specific risk like the management's ability. Or it may be a litigation against a company, has happened in what? Vodafone. It can be a management, what can I say? The ability of the management, the litigations, or a company product profile, or how the company is doing innovations. So these are all company specific. Are you following what I'm saying? Now, the company specific risk I can avoid by investing in all the companies. But all the companies, even if I invest, there's a risk for the entire system or not, because all companies are sitting inside a system. All of us are there inside the stock market only. So no, the stock market itself will be having what? Risk. It is called as what? Systematic risk. So what CAPM says that risk can be of two types: systematic, unsystematic. Systematic is called as non-diversifiable risk, and unsystematic is called as what? Diversifiable risk. To diversification, this risk can be reduced to zero. But still, some risk will not be reduced. The unleft risk is called as what? The systematic risk. This is what is the first point. Like Markowitz, I cannot reduce a total risk to zero and reduce only what? Unsystematic risk to zero. Point number one. Accept or not? So, this is a very famous diagram. It looks like this. So, this is number of securities. This is called as what? Risk. As the number of securities increases, the risk what? Decreases. Why it decreases? Due to what? Diversification. But even if I invest in all the securities, the risk will not touch what? Zero, because there is some risk which is going to be what? Unhedged. It is called as what risk here? Systematic risk. The balance is called as what? Unsystematic risk. Everybody, are you following what I am saying? This is point number one in CAPM. Yes or no? It's a very important point which changes the equation later. Can I say? Now. So now tell me, first point is what Markowitz said. Risk can be reduced to zero. What is it is right or wrong? Wrong. Risk cannot be reduced to zero. Even if you have a fully diversified portfolio, still the risk of what? System. So what cannot be diversified is called as what? Systematic risk. What can be diversified is what? The unsystematic risk. So unsystematic risk can be made zero, but not the systematic risk. Up to this, are you following or not? Can I proceed further? Next. Now, he gives an equation. KE is equal to, I'll go for the logic later. Let us first go one by one, step by step. Okay. CML has an equation or not? Like that. CAPM gave an equation called as SML. It is called as what? SML. Why it is called as SML? Why it is called as what? CML. Later we'll discuss. SML is equal to, KE is equal to RF plus beta into RM minus RF. What is SML here? K is equal to what? RF plus beta into RM minus RF. If I invest in a risk-free asset, I want how much return? RM. And more risk, more return. Less risk, less return. No risk, some return. என்னையா புரிஞ்சுதா? எதுக்கு மேல சொல்லாதப்பா. Okay, think and tell. Okay, more risk, more return. Less risk, less return. No risk, some return. Which you call as what? RM. Yes or no? Plus. I want a premium because I'm a risk-averse person. Kadaba. If I invest in market portfolio, if I invest in what? Market portfolio, the premium I want is what? RM minus RF. The same market portfolio, what CML said is also here only. It's not what I'm saying. So, if I invest in market portfolio, how much I want here? RM minus RF. But if I invest in the share, a given share, so I want to invest in MTH share, I want how much risk premium? Beta times RM minus RF. Point number 2. Yes or no? We'll know what is beta, how it is different from CML later, just step by step. You reckon how much is done here? Beta times RM minus RF. Point number 2. Are you following or not? Now, tell me. 2 points discussed. There are 2 types of risk, systematic, unsystematic. What cannot be diversified? Systematic. What can be diversified? Unsystematic. Unsystematic can be made what? 0. Systematic cannot be avoided. Number 2. Next is, this is having a line, SML, security market line they call it. What is the SML equation? KE is equal to RF plus beta into RM minus RF. We want to take no risk, I should ask how much return? RF. If I want to take a risk in market, I have to ask how much? RM minus RF. Either return I want for a market portfolio, so no. But for my company, the risk is what? Beta times RM minus RF is the risk premium. Up to this, are you following or not? Question is, what is beta? Next issue. What do you mean by what? Beta. I'll tell a simple idea about beta. The 6 formulas for calculating the beta. 3 will discuss here. 3 will be discussing during the sharp single index model where regression will be used. Are you following or not? So there are how many formulas? 6 formulas for beta. You'll be discussing in this stage. How many formulas? 3 formulas. 3 more will discuss in what? Yes, that is a sharp single index model. Can I put it or not? Now, next is, what is beta? Put simply, suppose I say beta is equal to 2 times. Beta of MTH gas stock is how many times? 2 times. For example, beta MTH gas stock is how many times here? 2 times. The meaning is, if the market return varies by 1%, the market varies by how much percent? 1%. MTH gas share return varies by 2%. In other words, market return increases by 2%, MTH return increases by how much percent? 4%. Market drops by 2%, MTH drops by what? 4%. For every percentage change in market return RM, my company return time how much percent? How many times here? 2 times. In other words, the company share is twice riskier than the market. Yes or no? My company is twice riskier than what? Market portfolio. Instead of investing in market portfolio, I am investing in what? MTH share. I am taking twice the risk what I take for the market portfolio. Is the meaning of what? Beta. First meaning. Yes or no? Lot of intricacies are involved. Is the prima facie meaning of what? Beta. I will discuss about beta in so many classes to proceed further. Are you following what? Now, is the meaning of a beta? Tell me. Beta is equal to 1.5 times. What is the meaning? Tell me. If the market return changes by 1%, the company return changes by 1.5. Market goes up by 1, company return goes up by 1.5 times. Market crashes by what? 1. Company crashes by 1.5 times. To put it simply, the company is how many times riskier? 1.5 times riskier than market. I should ask what? 1.5 times the risk premium. Right or not? Now, next. There are 3 types of stocks. Low beta stock, high beta stocks and equilibrium beta stocks. Are you following what I'm saying? Low beta stocks now, stock having beta less than 1 are called as what? Low beta stock. Stock having beta greater than 1 are called as what? High beta stock. Beta is equal to 1 is what? Equilibrium beta stock. In other words, if a company is having a beta less than 1, it is less riskier than market. Beta 0.9, market changes by 1, it changes only by what? 0.9. It is called as what? Low beta stocks. Right or not? No. Suppose beta is equal to 1, how market changes? Company also changes. It is as good as investing in company or what? Market is an equilibrium beta. Are you following what I am saying? Beta more than 1 means what? If the market 1.5 times means what? The company is more riskier than market is the meaning. Beta can even be 0 for risk-free asset. When the market moves, the risk asset moves what? 0 times. So 0 beta stock means what? It does not move at all. Everybody, are you following what I am saying? So this is a normal On the face of it, understanding of the concept of beta. Everybody respond yes or no. Okay, now listen what you discussed. CAPM says risk cannot be reduced to zero. There are two types of risk, systematic and systematic. Even if you invest in the entire market portfolio, RM, still I am having what? Sigma M. Why? Because I will be having what? Still some risk left for what? The entire market segment. Are you following not? Now, systematic risk cannot be reduced. Unsystematic risk can be made to us what? Zero. Now he goes for an equation. How much return I should ask for a share? Question arises no other question. Chapter objective. What objective of the chapter here? What should be a return asked? It depends on the risk taken. Yes or no? So the equation is K is equal to RF plus beta into RM minus RF. This equation they give a name called as what? Security market line. Called as what? Security market line. In that, no risk I want how much return? RF. We invest in market portfolio. How much I want? RF. What a premium ask for market portfolio? RM minus RF. Which we call as market risk premium. Yes or no? Into my company, how many times risky? Beta times risky. So beta into RM minus RF gives you what? The required risk premium. Respond yes or no? Who will ask this premium? Risk averse investor. That you should understand. Are you following not? Next step. What is beta? Beta measures the sensitivity of the share to what? Market. Beta 2 times now, market changes by 1, share changes by how much? 2% and vice versa. Low beta stock has got less than 1, high beta stock more than 1, equilibrium beta stock is equal to 1. Everybody up to this, are you following or not? Now, next. 2 more points I'll discuss. Time and 15 minutes more, yeah? Okay. Then I will leave you. Next. Wait, don't talk, don't disturb. Okay. Then next class you can revise and come, you can start doing problems. Yeah, can I see? Now, see. How to calculate beta? I have how many formulas? 6 formulas. Invest, I'll discuss 3 now. 3 during what? Sharp single index model where regression also should be thought. Can I proceed or not? Now. Okay. First formula is beta is equal to change in security return divided by change in market return. This is definition. When market changes by so much %, how much security changes? Beta 2 times means market changes by 1%, security changes by 2%. So the beta is equal to, the word triangle means what? Delta. Delta indicates what? Change. Change in security return divided by what? Change in market return. For example, when market changes by 2%, security changes by 6%. What is beta? 6 by 2, 3 times. So it is a definition only, nothing rare. It is a very approximate or ad hoc formula. We rarely use it. Are you know what I am saying? So what is beta? Change in security return divided by change in market return. It is the first formula for beta. Respond yes or no. This is not a formula, it is a definition. But what I am saying? Now, next. Beta is equal to, very good formula, frequently used, sigma S divided by sigma M into RSM. What is sigma S? Standard deviation of the security. Suppose I want to find out for MTH K in what is sigma S? Standard deviation of MTH stock. Okay. What is sigma M? Standard deviation of the market portfolio. Already discussed. Yes or no? Into RSM means what? Correlation of security and market. Right or not? No. The third formula is covariance of security and market divided by sigma M square. Sigma M the whole square. Covariance of what? Security and market divided by sigma M the whole square. This and this are same. This is only becoming what? This formula. Very simple. I'll put like this. Sigma S in divided by sigma M. What is correlation of S and M? Covariance of S and M divided by sigma S into sigma M. Yes or no? In the case, what happens here? Sigma S gets what? Cancelled. Becomes what? Covariance of S and M divided by what? Sigma M the whole square is a beta calculation. Everybody yes or no? A simple formula. Yeah. No, more derivations are there. Can I proceed now? So these are the 3 formulas. One I have learned for calculating what? Beta. See. What is beta? Beta is equal to change in security return divided by what? Change in market return. Second form, this is a very ad hoc or approximate formula. From second only accuracy comes. Second to sixth formula all will give you same answer only. Are you what I'm saying? Second formula is what is beta? Sigma S by sigma M into correlation of S and M. Third formula is what? Covariance of S and M divided by sigma M the whole square. Everybody following or not? Okay. Now Last point. Sir, earlier we said CML, now you said SML. Why two equation? Onne podum. Yes or no? Now what is the difference between CML and SML? What is difference here? This is the important discussion. One line discussion, important. Can I proceed or not? Now, see. One line, I don't think I'll complete in one line. Okay. I don't set for you. See. I am going to write both the equation. One is CML, another is what? SML. Okay. Participate. CML. RP. It is what? Written on portfolio. Here we call it as KE. Name only changes. I invest in a portfolio for which I want how much return? R. It is called as what? RP. Now here I call as what? KE. The return I want to have on the equity investment. Yes or no? So RP is equal to, tell me what the formula? RF plus sigma P by sigma M into RM minus RF. Yes or no? No. Sigma P means what? Standard deviation of the portfolio where I'm going to invest. Here we can call it sigma S. Only security is changed by what? Portfolio, that's all. Are you following what I'm saying? Now, this is CML. Now, look at the SML. SML is KE. It is what? K. Something similar to what? RP. RF no change plus beta. What is beta? Sigma S by sigma M into RSM into RM minus RF. Ennappa, right or not? Now, see. The sigma P and the sigma S are same only, name only change. As I am investing in a portfolio, I am investing in what? Security. This portfolio can even consume the security alone, it can be called a sigma S. Yes or no? Now, this sigma P is similar to what? Sigma S. Don't worry about S and P. Now I can say, between the two formulas, RF same. RM minus RF same. Yes or no? The sigma P by sigma M, sigma S, this is also what? Same. The only extra is what? RSM. Why is that? Other issue. Are you following? If this is missing, that will be called as what? CML. If this comes, it calls as what? SML. Are you following what I am saying? So the difference between CML and SML is what? The correlation of security and market. Everybody following or not? Okay. Now, for this only, you understand the spirit of the capital asset pricing model. Important point. Okay. See. I am a risk-averse investor. I would ask for a premium or not? The CAPM says, I should ask premium only for systematic risk. I have no business to ask premium for unsystematic risk because I can reduce risk through diversification. If I don't diversify, I cannot ask market. I am a lazy person. For laziness and all, premium cannot be given. Premium can be given what is uncontrollable. Are you following what I am saying? In that case, CAPM is very sure that a person should ask premium only for what? Systematic risk. You should not ask premium for what? Entire risk, because unsystematic risk, you can diversify it away. Are you following what I am saying? This is the important spirit behind what? The capital asset pricing model. Very simple. Now, RM minus RF is a premium for taking the market risk sigma M. In the market is the risk of the system. What I am saying? Now, my company risk, suppose market risk is 2. My company risk is what? 4. What I do is, I ask 2 times the market risk premium is what? My company risk premium. Yes or no? That means I ask a premium for the entire sigma. Sigma represents what? Risk. I ask a premium for the entire risk. The sigma P consists of systematic and then what? Unsystematic risk. Do you understand what I am saying or not? See, what I say, sigma M is the market risk. For that, what premium I want? RM minus RM. Is understood or not? Now, if this is a premium, I ask for a market risk. For my company, the sigma P, I would ask how much premium? Sigma P times RM minus RF by sigma M. Right or not? In that case, this is a premium asked for systematic, unsystematic, total risk, total risk. I ask a premium for the entire risk. Yes or no? But now what they say is, see, sigma S is the risk of the entire security. But this risk of entire security, why the security varies? Because market varies. Why Tata share performs? Why Axis Bank share performs? Why TCS performs? Because sometimes India may be performing. Why TCS share will not perform? Why Axis Bank may not perform? Because what? India may not be performing. Yes or no? So a portion of the security risk is influenced by what? Risk of the market. Yes or no? No. The question is, the sigma S is what? The risk of the security. How much this is correlated to market is RSM. Now, the sigma S is due to what? Suppose I say this RSM is what? 0. The RSM is what? 0. That means my security risk is not at all related to what? Market. The entire risk is what? Diversifiable. I should not ask a premium. Suppose the RSM is what? 1. The entire sigma is I can ask for what? Premium, because it is fully correlated to market. My security changes only due to what? Market. Everybody find what I am saying? Issue. Now, again I say, now, my security risk is sigma S. Accepted? Okay. This is variance in security return. What is standard deviation? Variance in return. Why the security return varies? Because the market varies. Because what? The market varies. Or it may even be because of its own factor. So the sigma S may be due to systematic as well as what? Unsystematic. I want to know how much of the sigma S is due to market. Yes or no? That means I should know how much the security is correlated to market. RSM is correlation of security to what? Market into sigma X gives you that portion of the risk which is due to the systematic factor. Yes or no? Balance, I will not ask premium because I have no duty to ask. Suppose the RSM is 0. That means what? The security moves not because of what? Market. There is no correlation between the stock market performance and then what? My security. No correlation with the market. Yes or no? In that case, for that security, is there any systematic risk? No. I should be asking how much premium? 0 premium. Suppose correlation is 1, it is perfectly correlated with what? Market. When market changes, security changes. Market does not change, security does not change. If there is a perfect correlation, then what it means? Then the entire risk is due to what? Systematic risk. As a full premium for sigma S. Suppose correlation is 0.9, out of sigma S, for 0.9 only I can ask for what? Premium. Balance 0.1, I cannot ask for what? Premium, because it is uncorrelated to market. Yes or no? What risk is correlated to market? Ask the premium. What is uncorrelated? Don't ask the premium. Hence, sigma P by sigma M, ask the premium for the full risk. Here, sigma P by sigma M into what? RSM, ask only premium for what? Systematic risk into RM minus RF gives you what? SML equation. So, SML is a development over what? CML, because they made you understand that don't ask a premium for the entire risk. You are there to work on your own. Yes or no? You diversify, and what cannot be diversified? Ask for premium. That should be the correct risk premium. Won't you ask for any security? Everybody following on with this? We complete this particular first stage introduction of what? The area called as capital asset pricing model. Yes or no? Now, I'll dictate the notes in the next class. Don't get up. You want now? I'll dictate not anything. See, before that, consolidate and go. Otherwise, you may be absent for the next class. I'm afraid. Okay, now, irpash. See, very simple. Forget all the old things. New thing is what? CAPM. Can I proceed? Now, first. CAPM says, stop talking. Don't pack. Please. CAPM says risk can never be reduced to 0. Risk can be how many types here? 2 types. Systematic, unsystematic risk. Systematic risk is a risk in the system itself. When you have a full diversification, I am still inside the system only, I will be having a systematic risk. Yes or no? This arises due to macroeconomic factors like inflation, GDP, business cycle, interest rates, etc. etc. Right or not? Unsystematic risk is company specific, like company's management's ability, litigations against the company, or company's product profile, innovations, etc. etc. Are you following what I am saying? Now, unsystematic risk can avoid through what? Diversification. Systematic risk cannot be avoided even through what? 100% diversification is point number 1. Right or not? For taking a risk, how much return you want? Question na? How much you should require? K is equal to RF plus beta into RM minus RM. If I don't want to take a risk, what I should expect? RM. If I want to take the risk on market portfolio, what I should expect? RM minus RF as a premium. I want to take the security risk, what should be the premium? Beta times RM minus RM. What is beta? How many times the security is riskier than market? Beta 2 times means security is twice riskier than market. So high beta stocks have more than one beta, low beta stock less than one, equilibrium beta is equal to 1. How to calculate beta? Three formulas just for the time being. What are three formula? Change in security return divided by change in market return. Second formula, sigma S by sigma M into correlation of S and M. Third formula is what? Covariance of S and M divided by sigma M the whole square. Now we have two lines, CML and then what? SML. CML asks a premium for the entire S. CAPM says that you should not ask a premium for unsystematic, where you can diversify it. Yes or no? In that case, I don't ask a premium for sigma S by sigma M. I ask for what? Sigma S by sigma M into correlation S and M. That part of sigma S, it is correlated to what? Market. Only can ask for a premium, not for the full risk, is the meaning of a CAPM. Yes or no? Next class, we have to discuss about underpricing and overpricing and start doing the problem.
Thank you friends. OMSAI Bhojanapalli.